If you're self-employed, you already know the deal. No HR department, no pension, no company match. You are the match. Your income chart keeps rising, but your anxiety chart, it never comes down. Because here's the truth. Even when you're earning $300,000 or more, you can still feel one bad quarter away from being broke. Not because you're irresponsible, but because you're trapped. And there are 3 invisible wealth traps holding even the smartest entrepreneurs hostage: the tax trap, the volatility trap, and the liquidity trap. You escape the 9 to 5, but if your money still works like an employee, you never really left. And if success still feels like stress, the next 8 minutes will finally show you why and exactly how to break out. Hello, my name is Robert Balgac. I'm the founder and CEO of Black Swan Insurance Group. And since 2017, we've helped more than 20,000 families protect and grow their wealth, earning 800,000 plus 5-star Google reviews. We show entrepreneurs how to turn cash flow into control using IRS-approved tools like Index Universal Life, structured under Tax Code 7702 and 101A for long-term tax advantage cash value. So if you'd like to see how this could work for you and your business, click the link below to book your tax-free wealth strategy session with us. Meet Irene, a 50-year-old business consultant in Chicago. She spent 20 years in corporate before launching her own consulting firm. Now she earns $310,000 per year, sets her own schedule, and runs her life. But Irene doesn't have a 401k, no employer match, no pension. When she walked away from the corporate world, she gained independence, but lost her entire wealth structure for retirement. And every April, she writes a $90,000 check to the IRS and promises herself she'll figure it out next year. When I asked her, "So Irene, what's your retirement plan?" She laughed. She said, honestly, wishful thinking. And she wasn't joking. She was exhausted. And then she said something that hit really hard. "I make more than ever, but I never felt poorer." So we walked through the 3 traps silently draining her wealth and how flipping them would become actually her advantage. The first trap is the most common and the most dangerous. It's the trap every high earner thinks they understand until they don't. This is the trap of deferring instead of defending. Employees dump money into 401ks and IRAs, thinking they're saving on taxes. But they're not saving. They're delaying taxes into a future with unknown tax rates. If tax rates rise, you didn't save a dime. You just postponed the pay. The IRS didn't design the 401k to build your freedom. They designed it to delay their payday. Irene didn't have a 401k, and it turned out to be her secret advantage. It's like refusing to board a plane you already know is going to fly straight into turbulence. Instead, we've created her tax-free freedom fund, a properly structured max-funded IUL under Tax Code 7702 and 7702A. She uses after-tax dollars now, and her cash value grows tax-deferred. And she can access it in a tax-advantage way later through policy loans. While her friends are deferring into future tax brackets, Irene already paid on seed and secured control of her harvest. But even if you escape the tax trap, the next trap can erase decades of progress in months. And Irene learned that the hard way. The second trap, volatility, the invisible wealth killer. Back in the corporate days, Irene's old portfolio was 100% market-based. Back in 2008, she watched 45% vanish in 9 months. It took her over 6 years to break even to pre-crash levels. And if you ever experienced that, you know, losing early takes years to recover. Sequence risk pushes entrepreneurs harder than anyone. It's like climbing a mountain while the ground crumbles under your boots. Now, inside her IUL, Irene has a 0% floor, no losses from market downturns, and cap of 10%, a steady, responsible upside potential. And when the markets fell in 2022 by around 20% in a year, her policy posted a clean 0%. No panic, no sleepless nights. Irene stopped checking the market app on her phone, which probably lowered her blood pressure. And with volatility removed, Irene stopped watching CNBC and started watching sunsets. That's how you build confidence into compounding. But even with taxes tamed and volatility removed, Irene still faced the trap that steals opportunity, the one every entrepreneur knows too well. The third trap, liquidity. Entrepreneurs often have money on paper, but none they can actually use. The best opportunities show up when your money is locked up somewhere you can't touch. Irene wanted to invest in a friend's startup, but her cash was tied up in a taxable brokerage account with investments that would have triggered capital gains. Selling stocks meant taxes. Pulling from savings meant stress. Liquidity is like oxygen. You don't really notice it until you can't breathe. So instead, she borrowed $10,000 from her IUL's cash value. No taxes, no penalties, no 1099s, no permission required. And her cash value continued compounding inside a policy while she used to help her friend. For the first time in her career, Irene spent money without asking the IRS for permission. That's when she said, I thought not having a 401k was a disadvantage. Turns out it was my superpower. Now let's turn these insights into real numbers, because Irene's payoff is the blueprint you need to see. Let me show you exactly what Irene's tax-free freedom fund looks like using the real illustration values. From age 50 to 64, Irene is planning to contribute $5,000 a month, $60,000 a year in a 15-year max-funded IUL. Total projection premium paid, $900,000. And then at age of 65, she flips the switch and she starts taking $109,685 per year tax advantage. And she continues receiving that amount every year from age 65 through the age 100, if she makes it that. That's 36 straight years of predictable, tax-free, accessible income. Total tax advantage income in this time period, almost $4 million. But here's the part that shocks most entrepreneurs. Even if Irene withdraws over $100,000 every year, her accumulated value, the cash actually compounding inside a policy, keeps rising. So here are the actual numbers. At age 65, her cash value is going to have $1.29 million. 5 years later, it's grown to $1.7 million. Then 10 years later, at age 75, it's $2.3 million. And at age 80, 15 years after she stopped contributing, the cash value is $3.3 million. Okay? At age 90, it grows all the way up to 7.3. And at age 100, we hope she makes it that long, it's going to be almost $15 million in accumulated value. So she's withdrawing six figures every single year, and her accumulated value grows from 1.9 million to 14.9 million. That's not magic, it's math. IRS compliant, mathematically sound, volatility protected design. So let's connect all the dots. Irene puts in $900,000. She can take out almost $4 million by the age of 100, and she still leaves $451,000 tax-free death benefit to her family under IRS Code 101A, all without stock market crashes, capital gain taxes, no sequence of return risk, no IRS penalties, no 1099s, and no required minimum distribution. This is what it looks like when your wealth works like an entrepreneur, not like an employee. And now that you've seen Irene's real numbers, let me show you the anti-trap checklist, the same one she used to escape 3 traps that keep entrepreneurs broke. Number 1, the tax trap, stop deferring into future tax rates. Number 2, volatility trap, protect your principal with a 0% floor. And liquidity trap, keep access without penalties, taxes, or permission. A properly structured max-funded IUL addresses all 3, tax advantage, protected, liquid. And to help you with your customized structure to avoid these traps, you can book your tax-free wealth strategy session with us. Click on the link below. You don't need Wall Street's plan or corporate benefits packet. Just your number, your structure, your discipline. The day that you escape the tax trap, volatility trap, and liquidity trap is the day your money is finally working for you, not against you. Because at the end of the day, it's not what you earn, it's what you keep. Enjoy the ride.